So we realize that making loans and gifts to family members is a very personal decision. Sometimes we do it out of a feeling of generosity or appreciation. Other times, these types of decisions are made out of a feeling of obligation or worry about the recipient's well-being. There's usually concern for how this might impact you and your other family members. Loaning or borrowing money for a family member might sound like a good idea. It's easy loan approval, interest payments can be non-existent or less than the borrower might receive from the bank. But these arrangements can also have pitfalls. To be successful, clear communication and expectations must be set for both parties. So Kathleen, what is the first thing that should be considered before agreeing to make a loan to a family member?
Carol, first of all, I want to just welcome everybody to being here. This really is an interesting topic and one that can really work out very well when it is done properly, but it does have a lot of pitfalls that you need to think about before moving forward. So there's actually many things that people should consider before entering into a family loan. And when we talk about a family loan, it can be either with an immediate family member that you loaned money, or you're the borrower and you're looking to, borrow money from a family member or a loved one. It can also be, loans that are made, let's say, with close friends or, people that you have some kind of close relationship with. And a couple of things that you want to consider before you even get into whether you want to set up the actual loan or not. First of all, you want to think about, is this actually a loan that you're trying to create, or are you looking for a way to gift money to someone? And there's very different, ramifications for both of those approaches, and both, positive sides as well as risks, whether you're actually looking to do a loan or a gift. Am I looking to create a loan in which I'm actually going to receive this value back again over a period of time, let's say, and coming up with what the terms would be for that repayment structure? Or am I looking for a way to find to gift somebody a loan? Is my intent, gift somebody money? Is my intent that I'm actually going to couch this as a loan, but I'm going to forgive it later on, that I'm going to make this a gift? Or am I going to use some kind of a hybrid? Maybe I'm looking to loan somebody money so that there is a certain portion of that value returned to me over a period of time, but at some certain point in the future, either by my choosing or by my death, that this loan is forgiven and it then becomes a gift. So thinking through what the intent is with respect to giving money, loaning money to someone else, and what you believe is really the purpose of this transaction. That's really critical. Is it a way of actually giving money to someone in which you're going to get something back, get that loan amount back? Or are you looking for a way to kind of do a wealth transfer, a gift? A couple of other things that you really want to think very, very hard about is, are you comfortable making this loan? And that comfort level involves many different things. It involves the relationship that you have with the potential borrower. How is this going to impact that relationship? You want to think through that. And we'll talk a little bit about the things that impact the relationship and how you have to consider them. How does it also impact the relationship with other people? So let's say you are loaning money to one child or to a niece or a nephew. How does it affect the relationship that you may have with your other children, with your other nieces and nephews, the other important people in your life? What is going to be their thoughts on the loan? You can certainly keep the loan private, but there's always the potential that it can come to light. And how will that affect the relationship that you have with others and the relationship you have with the individual or people that you are loaning money to? Are you concerned with how the money is going to get used? A lot of times when we gift money, we do so in such a way that we give away the value, but Then when the individuals make choices that we might not be really comfortable with, let's say they go on vacations and you have loaned them money, but they're off enjoying a quality of life or choices in their life that you don't necessarily approve of, how does that affect the relationship and your view in terms of the money that you may have loaned them? So, when you're looking, again, that's one of the things that you need to think about when you're entering into the loan as to the purpose of it. What are you really trying to achieve here with respect to the loan? Is it just to make sure that, the borrower gets the money and can do as they choose with it? Or do we also want to make sure that the borrower has a specific purpose for the use of the money? So that's something else you want to think about. Are you just giving this money to the borrower, allowing them to make decisions about what they're going to spend it on? Or are you giving it for a specific reason and a specific purpose, and it must be used for that? So for instance, you're allowing them to borrow money for or to assist with the purchase of a home, and it only can be used for that purpose, not to be used, by the way, to pay down their bills or to buy a car that they may need or something else. So you want to be very clear with what is the intent in terms of the use of the loan, and do you as the lender want to ensure that it is being used for only specific purposes, or are you making this loan for more general purposes that can be then determined by the borrower themselves? Another thing that you really need to look at is, how does this affect your life? Because remember, when you're loaning money to someone else, you are giving it away, and it's no longer available to you to take care of your needs, to make sure that your choices in terms of your own lifestyle, your quality of life, your wishes and future choices may be affected by the fact that you have given away a certain value at this point and are now waiting for it potentially to be returned over a period of time. So you've got to really take a look at your own finances, look at your own situation and your own goals, and make sure that loaning this money is not going to negatively impact that in a way that you are not comfortable with. So really thinking about one of the things that I would say, regardless of whether you are loaning or gifting, is really thinking about the impact that is going to have on the relationships that you have, on the use of the money, your own thoughts about how this person may be utilizing your gift and or loan, and the other choices they may make in their life and how that impacts you. And the fact that you are giving away monies or value that you could otherwise use now or in the near future for yourself, and you'll no longer have access to that. So you really want to think through very, very clearly all of this impact on you and whether this is truly something that you want to enter into.
Thanks. Well, what are some of the benefits and risks of family loans?
So let's say you've decided, I want to go ahead and make this loan. A couple of the things that you want to think about, again, in terms of both benefits and risks. The benefits can be that you're able to loan the money to the borrowers, to your family members, at a much lower interest rate than they might otherwise be able to obtain. So for instance, and I'll talk a little bit about how interest rates play into a family loan, but let's say you are choosing to go ahead and loan money to a child, a niece and nephew, another loved one. You're able to actually charge them a much lower interest rate. I believe the interest rate right now, it's actually called the applicable federal rate that applies to make the loan comply with the IRS regulations. And again, I'll explain why that's important in a few moments. but you can actually loan them at about a 1.85 to about a 2.66% interest rate. And it depends on the term of the loan. The loan can either be short term, meaning that it's expected to be paid back within about a 3-year period of time or less. A midterm loan, which is expected to be paid back within about a 3 to 9 year period of time, or a long-term loan, which is more than 9 years in terms of the expected payback. So there are interest rates that apply to each of these different loan types. If you Google literally the applicable federal rate, it will talk about what the current rate is. I believe I actually had looked at it and they had January's rate up. I had to do a little bit of digging into the IRS. Every month they publish the new applicable federal rate, and we have had an interest rate increase this year. And so there is a fairly substantial change between January's rate and the current rate. And there is a huge change between last year's rate and this year's rate, or this current rate. And that is really because the IRS does adjust this rate on a monthly basis. And so Google applicable federal rate. And so wondering if I could, Carol, skip a little bit to why the interest rate is important.
Okay.
So I talked originally about you need to consider whether this is truly a loan or whether this is a gift. And the IRS actually defines what is a gift. They talk about a gift as being defined as a transfer of property or money to someone else without expecting to get something of equal value in return. So if you loan money to somebody with a 0% interest rate, the IRS says, you may have an agreement for a payback on this, but there's no guarantee you're going to get this back again. And so they really classify those types of agreements as gifts, not as a bona fide loan. To really make this a bona fide loan, you've got to make sure that there is the applicable interest rate, the minimum applicable interest rate. Now, you could go more. So you certainly could charge whatever interest rate you and the borrower agree to. I have seen sometimes where a parent will take a line of credit on their home in order to be able to finance the loan for their child, let's say. And the expectation in the repayment of that loan is that the child will cover not only the principal repayment of that, but whatever the current ongoing interest rate is, so that the parent is made whole. In that case, the child is paying a higher interest rate because it's whatever the parent is being charged to borrow this money themselves. In other circumstances, again, to make it a bona fide loan, they can charge that lower amount, whatever that applicable federal rate is, and be able to utilize that as kind of the benchmark in terms of the interest expected. So the market interest rate generally needs to be applied for the IRS to actually treat this as a loan and to actually see that it is a loan agreement itself. The other thing that the IRS requires is that the terms of the loan have to be enforceable. So there has to be clarity in the loan as to what happens if there is a non-payment that occurs. What happens if the borrower decides not and they default on that loan? There has to be a way for the lender, the parent or the loved one who has given this money, to be able to actually enforce the loan and to make payment occur. But if someone right now is going out and getting a loan, we're seeing where the Fed has increased the loan rates, the interest rates. And right now, a typical commercial mortgage is somewhere around 5.25%. So that's a huge difference in terms of the buying power that you're able to give someone with a loan amount that is so much lower. Another thing is that you're able to come up with the terms of the loan. Again, a commercial loan, whether it be a mortgage or a personal loan that someone gets from a financial institution, you really don't have a lot of leeway in terms of the terms. So you're able to come up with mutually agreeable terms. Let's say payments would be made on a quarterly basis. Maybe payments are being made on interest only for a period of time. You're really able to be flexible in terms of those terms so that they meet both your needs as the individual who's loaning and the needs of the borrowers a little bit more customized than certainly anyone would be able to get from their local bank. Another thing is that you can have much more flexibility if the borrower runs into problems. You have more opportunities to be able to make decisions about whether you will go into forbearance with the loan. So for instance, your loved one has lost a job, they're not able to make payments for a period of time. You will have the flexibility within a private loan to say, I'm going to let you not make payments for a 3-month period of time, a 6-month period of time without defaulting on the loan. Where if it's a commercial loan, there are very strict requirements regarding something like forbearance and how that is obtained, whether someone would qualify for a forbearance, and whether they would be in a default on the loan much sooner. So much more flexibility around the rate of interest that you end up applying to this loan, the terms of the loan in terms of repayment so that there's flexibility so it meets both yours and the borrower's needs. And you have much more flexibility in terms of allowing for allowances around not making payments for a period of time if it's mutually agreeable to both you and meeting the borrower's needs. Let me, if I could, one more benefit, there's no need oftentimes with a family loan for the borrower. There's lots of benefits from them in the standpoint that they don't have to meet many times the same kinds of loan requirements. They don't have to have income levels, etc., that are being scrutinized by a third party to make sure they meet certain requirements in order to be able to qualify for the loan. So you as the lender in this situation can really have a lot more flexibility in what you're coming up with terms for the loan itself and for how somebody may be able to repay that loan. Sometimes people enter into these types of loans, and one of the benefits or potentials that they're looking for is to help build credit for the borrower. So the borrower is, potentially younger or have had credit issues in the past, and they're saying, I can't get a conventional loan, so let me enter into a loan with a family member, but I want this to be something that I can use to be able to really build my credit. To let that happen, there has to be some additional things that occur with respect to the loan. One of them is that they have to be reportable to the 3 credit organizations. So there has to be, an agreement, and you have to think through if we're really looking to use this not only as a tool to get money over to a family member, but we're looking at also as a tool to be able to build credit for the borrower. We've got to include an ability to be able to report this loan to the 3 credit union organizations, and to be able to report the repayment history. So it's important that there is no default on this, or again, that there's a mechanism, there's an agreement if there's going to be any delay in payment between the members in order to continue to legitimize this loan within the eyes of the 3 credit unions, or the 3 credit organizations, excuse me. But some of the risks, and these are huge risks that you need to be aware of, certainly non-payment. So the borrower, for whatever reason, decides not to continue making payments to you. Now you're in a situation that you need to think about, am I going to go ahead and sue my family member? How do I make sure that the terms of the loan continue to be honored by all, and that payment continues to be made? One of the things that can happen is you've loaned your family member the money, they've gone ahead and spent the money. Now they don't make payments to you, and you no longer have something to be able to leverage against to ensure that that money is going to come back to you. So there is a high level of risk that you enter into with these types of loans often. I'll talk a little bit about how you might help to mitigate those, but it can be very risky as to whether your borrower does not end up paying you back. And then you have to think about, how does that damage the relationship? What's Thanksgiving dinner going to look like when the borrower of a loan from you is sitting at the table and isn't making their payments on time, or hasn't communicated with you for the last 6 months, and now they're right there at the table? How does that work? So you have to think about the relationship part of all of this as well, and the impact that the borrowing party not living up to their obligation can have on your relationship. Also, as I talked about earlier, it's more than just you and the borrower themselves. It can impact other family relationships. If you've loaned money to, let's say again, one child, what's your intent in terms of the other children? Now, it may be, you know what, the decision is this one child needs the money, I'm loaning it to them. This is between me and my child. My other children are doing fine, and I'm not going to worry about that. But in many circumstances, it causes potentially bad feelings with the other children. Why is this child getting more money than we are? Maybe there's ways of being able to take care of this, and we'll talk about how, again, you can kind of mitigate some of this if you chose to. For instance, you might change how you ultimately distribute your estate, and that the child who you loaned money to gets less of the estate when you die. But again, the other children may not be happy that they are not receiving the same benefit in real time that their other sibling received. So you've got to really consider that whole relationship. It's between you and the borrower and how that relationship works, but the impact that it has on others in your life. And another issue, another downside again, is that lack of funds. And how does it impact your life when you have taken funds that would otherwise be available to you to use in real time, to use to take care of your needs, your wishes, your desires and goals as you go forward, and you've now loaned this out to another, and it's no longer available for you when you may need it. And so really need to look at your overall financial situation and make sure that this is compatible with your lifestyle, with your goals, with your desires as you continue to move forward in life.
Are there alternatives to family loans that should be considered?
There are. Loaning money is not the only way to move forward with trying to help out a loved one. One is to go to the outright gifting, that you make a gift. Right now you can make a gift of $16,000 per person per year, without having to file a gift tax return. If you make more than that, and by all means you may make a larger gift than that to an individual each year, but you are to report to the IRS the overage of the $16,000 that you gifted. There's no gift tax due at this time. And right now, the gift tax level is at approximately, I believe it's about 12.8 million over your lifetime. Now, that isn't a pure gifting amount. It includes some other things. It's actually a combined gifting and estate value amount for federal. But there is right now a very large amount of money that an individual can gift over their lifetime above that $16,000 a year limit. So gifting outright is absolutely a way of being able to help somebody. But just like when you make a consideration of a loan, you have to think about what your own value system is around a gift. Are you willing to give a gift and let it then be spent by the recipient in any way that they choose? Do you feel like if the recipient is now off spending money, they're taking very fancy vacations in your mind, maybe they are being very, they're not being very frugal or very careful with how they're spending their money. How does that make you feel, and how does that impact your feeling about the fact that you gave them money, or if you choose to loan them money, that you loan them money? So you have to think about your own feelings around all of this and what your expectations are with respect to the gift that was made or the loan that was made. Another possibility is that you become a co-signer, let's say on a loan. So you, instead of loaning the money yourself, your loved one does go out, enters into a commercial loan of some type, be it a mortgage or a personal loan, and that you act as a co-signer in order to, again, this allows them to be responsible for the loan, although remember, as a co-signer, you are usually jointly responsible for that loan, which means if they don't pay, guess what? You pay. And that if they don't pay and you don't pay, it affects both of your credits in the future, your credit worthiness. So being a co-signer in and of itself has its own risks, but it is a way to help your borrower begin to establish commercial credit. And if they do all that they should do with respect to that loan, then it really does help them to build credit on their own, and does make it so that there is, you're not loaning the money yourself, they're getting that money from a third party. So it can absolutely be a way to be able to help support them if they can't obtain a loan on their own.
Okay. Excuse me. So Kathleen, we do have a couple of questions in the chat box if you are ready for that. For the applicable federal rate, which compounding should we use? I don't know if this is getting a little too financial. It is for me anyway. Which compounding should we use? Annual, quarterly, etc. And what does the 120%, 130% mean?
So the compounding is really dependent on how really you want that repayment structure. So that's one of the things that we would look at as to how you wanted that repayment structure. There is a specific, and I do apologize, I can try to get the actual IRS regulation. There is this, there's several applicable federal rates. You'll see that there's several different categories. And I want to say it's 2754, but I do apologize, I'm not 100% sure. I can take a look at that. I have to look it up again and can tell you exactly which table you should be using. Again, we have to look at whether we're talking about what the loan time frame is, the expected loan time frame too, to help us determine which rate we can use. So there's a couple of different factors that go into it. There is a specific table for personal loans that are that applies to personal loans, and then it will also determine on the repayment structure and the length of the loan.
We might be touching on this in a little bit, but what are typical recourse or default terms that are used in family loan contracts?
So we definitely will talk about that, but this is when somebody has not, they're defaulting on the loan, meaning that they're not making payment. Certainly it can be things like an increase in the interest rate might be one thing, that if you don't make payment within a certain period of time, there's a penalty that can end up being applied. It can be that the payment schedule is accelerated. So, you were originally given 10 years to pay this back. You don't make a payment, we can now demand it immediately. The issue is that with any repayment or default language that may be there, the old adage of you can't get blood from a stone really does apply. So great, you can bring somebody to court, you can find they're in default. Now they have, and you have the ability to be able to demand the payment. But what if they don't have the ability to make that payment? They don't have assets for you to be able to attach in some way, or even income, future income. They're not working. So yes, there's absolutely language that we can put in to deter someone from defaulting on the loan, but ultimately, how are you going to be able to make good on any kind of judgment that you may obtain against the defaulter? But we'll talk a little bit more about that. One of the things that potentially you could do is there collateral that can be used to secure that loan? A vehicle that they own outright. Typically, they don't have property, but if they had property or something of value that could be used and kind of pledged in order to provide collateral. That is a way of being able to kind of make sure that there's something to be able to grab should the borrower default. But that's not something that we typically see in a family loan, because oftentimes one of the reasons that the loan is being made is that there isn't the asset base that the individual has to be able to get a commercial loan on their own. So again, there are ways we can do it, but in practical terms, it's not something that we often see. And even though we can be very clear about what will happen if the borrower defaults on the loan, you may be in a situation in which you've won, the battle, but you've lost the war because there's nothing for you to be able to get at.
How is the loan info reported to a credit organization?
So it's actually that the terms of the loan can be reported, so that as just like when you go and obtain a credit card, the fact that you've obtained that credit card and the balance terms for that credit card, the available amount of credit is all reported to the credit organizations. So the same thing can be done for the loan, that this is a loan that's put in place. Here are the terms of the loan, the expectations around the loan, and then the payments as they're made are reported that they're made on time, or if they're not made on time, the fact that they are delinquent is reported. And again, it has both the positive part or the positive impact on the person's credit and the negative impact. It does, and this is something you have to think about if you're going to enter into this kind of loan with a family member, is the fact that now you've got these reporting requirements that you have agreed to. How are those going to be made? Who's going to do it? What's the responsibility of the parties? How do you do it? You need to make sure you've got that all clarified and you know what you're going to do to make that happen.
So if we decide that a family loan is the way to go, what should be done?
Okay, so number one, even though a handshake can be considered a contract, don't rely on a handshake. This needs to be a written agreement. This has to be very clear in terms of the terms for both the lender and the borrower. So first of all, you want to start with that conversation of understanding everybody's expectations around the loan. What are the specifics of the details? How long the loan is going to be for, how many years, months, etc. What the payment expectations are. Is this a monthly payment? Is there a specific day of the month that it needs to be made by? Is this a quarterly payment? How are payments to be made? Is it an interest-only payment for a period of time and then the return of principal? How are you going to handle that aspect of it? Make sure you're very, very clear and that both of the parties understand it. Make sure that everybody understands, are there expectations around the use of money? So if you are saying, I'm going to allow my child to borrow money for a down payment on a property, you want to make sure it's clear in the loan, if this is in fact your desire, that that money only be used for the down payment on a property. You can even be so specific as to what property it's used for if you chose to. What are, again, the expectations, even things like where should the payment be sent? As I said, when should the payment be sent? All of that should be very clearly outlined and discussed. You also want to use this time to, again, understand the impact on the relationships with others. So for instance, if your intent with the loan is that payments are to be made during your lifetime, but if you pass away during the term of the loan, you forgive it, then what does that do for the other members of your family? How does that impact them? Do you want to make changes to your estate plan to make sure that, let's say, other members are made whole by having this loan amount maybe forgiven, but the overall distribution from your estate to be altered so it takes into account the value of the remaining loan that had been forgiven? Or maybe you say, no, if I forgive the loan or if it's forgiven due to my death, that's too bad. Everything is still going to get divided equally among my remaining children. So things that you want to think very clearly about beforehand and make sure that you have clarity and it's in writing, whether it be in the loan document itself, in terms of the terms of the loan, or in the other aspects of your estate plan to make sure that your goals are being met. There's no such thing as being too detailed when it comes to thinking through these kinds of decisions and making sure that they are written down. You also may want to have, legal counsel for both sides, because again, they can be you can all have very mutual goals here, but there are very different benefits and risks for each of the parties. And so it is not unusual to see each party have their own legal counsel just to review and make sure that each party understands fully what their obligations are under the loan. You want to take steps to protect both the lender and the borrower in this situation. You want to make sure everyone understands what their obligations and what's expected of them. A couple of the things that the person on the lending side should be thinking about, again, how much can you plan to lend? How is it going to impact your life? And are you able to actually lend this money without harming yourself in the short run or in the long run? Why are you lending the money? Think a lot about what your reasoning is and whether this is something that you feel you can support as time goes on as to why you're lending this money. Do you expect to be repaid, and can the borrower repay you? So you really want to take a look at the overall situation for the borrower and what's going to happen. You have to think through what happens if the borrower can't. And it can be for reasons such as the borrower becomes disabled. They may, for no fault of their own, there may be a change in their circumstances. A possibility could be, certainly if the borrower passed away during the terms of the loan and the loan is of enough value, should the borrower get life insurance to be able to make sure if something happens to them that you are made whole? Or even looking at options such as disability insurance, should something happen to them and they're not able, let's say, to continue to be gainfully employed and be able to make money to repay this loan. Are there other ways to be able to kind of ensure that so that you're made whole as the lender? So you can think a lot outside the box about how you might be able to really make it so that if something unforeseen were to happen, how do you make sure that the lender continues to be made whole in the end? Got to think about that interest rate. Do you want to make this a legitimate loan for IRS purposes, or really are you looking to gift money ultimately in terms of your relationship with that borrower? And are you concerned about how the borrower may utilize, we talked about utilizing the money, but we're going to talk too on the borrower's end of it, some of the things they need to think about. They've got to think about how do they protect that investment. So let's say they borrow money from somebody and there aren't any particular expectations for how they use that money. They want to make sure that they are taking steps to protect that value. So again, if they get into a situation in which they can't make the monthly payments, how do they make the lender whole? How do they make their loved one whole who has gone ahead and given this loan to them? They want to make sure that they've done an honest assessment of their own earning potential, their ability to be able to pay this loan back again. Can they meet the terms of the loan? And on the borrower's side, not that it becomes, the borrower in many ways has a little bit less of a risk in the sense that they choose not to make those payments. Again, the lender is really the one who's in a position of having to enforce those terms, and they're having to go against their borrower loved one. And that can be a very, very difficult position for the lender to be in. So, again, one of the ways that the lender can help protect themselves is to think about, is there a form of collateral that can be used to support the loan, to be able to say, if you don't pay it back, I'm going to be able to go after this asset of yours. And the borrower has to think, if they're going to enter into that kind of relationship, are they able to put that asset at risk in order to be able to get this loan? You want to make sure that the borrower is encouraged to really safely maintain those funds. Now, whether it be invested in something like a property, that it be a property that they can afford otherwise, that they can, if they need money for the down payment, are they able to afford the actual payments? If there's also a traditional loan in place for this, are they able to maintain the property? Are they able to pay things like the water bill and the taxes on the property? People buy a property and they often worry about, well, can I handle the mortgage payment? But as any of us who own property know, there's a lot more that goes into the expense of maintaining and managing a property than just making the mortgage payments. And so you want to make sure that the overall picture for the borrower also is able to support whatever this purchase or investment may be, if that's what the money is being used for. And it is critical, particularly on the lender side, but on the borrower side as well, that they keep really good records, because again, you want to be able to show, if you're the lender, you want to be able to make sure that you're keeping records of payments coming back to you, that you know what you're receiving in terms of return of your principal and interest that you might be receiving for tax purposes. You also may need those records for purposes of other loved ones to show, no, that Susie really did pay back the loan, here it is, and the others, again, to quell some of that relationship issues that may arise between family members, that know this individual is living up to their obligations or completed their obligation. And certainly for the borrower to be able to show that they did make the payments, that they were made on a timely basis, and that they did in fact make sure that that loan terms were met, and that they no longer hopefully owe that money anymore at the time that the loan is completed. So you can never be too detailed in terms of the thinking through of these loan situations and memorializing them in writing so that everyone understands clearly what their obligations are under the loan. If you can, coming up with ways to secure payments, should there be something that happens to the borrower, either death, disability of the borrower, looking at other ways that that might be secured, or using forms of collateral to be able to secure the loan, can really be helpful to make sure that the lender is made whole should something happen. Again, you can have default terms in a loan, but they always require enforcement. And even with enforcement, should a borrower default on a payment, you may find that there is nothing to go after in order to be able to actually now make the lender whole. And so family loans can be a fantastic way of being able to help out a loved one, to get them into a position that betters their life. But you as the lender really need to think clearly about why you're doing this, and what you can accept in terms of how money is used, how repayment is made, and making sure that it doesn't negatively impact your life in the present and expectations for yourself in the future.
Thank you so much, Kathleen.
Absolutely, and I hope that was helpful for people. Really, these can be excellent ways to move forward, but you just want to be sure that you're thinking about all of the different ramifications, because it isn't, it sounds wonderful. I'll just loan money or I'll borrow money from my loved one, but it can have a much greater impact, and you just want to make sure you think through all of that.
Words of wisdom. Thank you so much. Have a good day, everybody.